Hi, I'm Ramiro. Thank you for joining me on my channel. So when we're talking about investments, one of the terms that we hear about is market volatility. But what is market volatility? And what can we do to protect ourselves from it? Well, let's talk about it today. So what is market volatility? Well, what it is it measures the level of price fluctuations on any given financial instrument or market index. In other words, the greater the price fluctuations, the higher the volatility. And the lower the price fluctuations, more price stability you have, the lower the volatility. So, what are some of the things that create market volatility in our world? What I'm going to do is I'm going to go over a list, and obviously it's not all inclusive, but I believe it's the major ones. And after I list the causation, then more importantly, I'm going to discuss what we can do as far as strategies to protect ourselves from it. So, let's start. So, here we go. The first one is economic indicators, and that is the government, our government on a regular basis, usually quarterly, comes out and they release reports on a variety of things that's going on in our country. So, for instance, like the unemployment rate, also the GDP growth. In other words, gross domestic product. Is our economy growing? Is it shrinking? And then a big one here is inflation rates. That has become a big topic of discussion lately. Thank goodness inflation has been dropping down so much. But those kinds of reports and that kind of information, if they differ significantly from expectations, that can cause a lot of volatility in the markets. All right, let's keep going. Number two, geopolitical events. So, is there political instability in the world? Are there conflicts or wars in the world? What about trade disputes? All these geopolitical events can lead to uncertainty. And let me tell you, whenever we have uncertainty out there, that adds a lot to the volatility in the markets. Third one, market sentiment. What are investors' perceptions and emotions? Do they have fear, greed, uncertainty? All those emotions can drive buying and selling behaviors and pressures, therefore resulting in more volatility. You guessed it. Fourth thing is company performance. On a quarterly basis, CEOs will host meetings, and during those meetings, they're going to release information on what their company earnings have done. Also, if they had recent product launches, were their products successful? Are they going to be launching new products in the future? Have there been management changes? So, whatever this CEO is sharing with us, that's either going to drive investor confidence up on that information, or it's going to drive investor confidence down. And either way it goes, that can have a huge impact on the stock price of that company, therefore affecting, you guessed it, market volatility. What's another thing? Well, interest rates and monetary policy. If you've been hearing the news, it's always on the news, and people want to know, is the Fed going to raise rates or are they going to drop them? So, depending upon what they do with interest rates, that can really impact the cost of borrowing. So, how much is it going to cost us to get a mortgage or to finance a car? That can have a big impact on the economy and therefore affect volatility. The other thing is monetary policy. Are they going to be increasing money supply, decreasing money supply? Whatever they decide to do, that has a big impact on our currency values. And once again, all those things have a big impact on market volatility. So that's my list. And so, what are some of the things that we can do to protect ourselves from all of this? Well, I'm going to list them and then I'm going to go back and discuss each one individually. So, here's my list on the strategies that we can do to help ourselves: diversification, asset allocation, use of derivatives, staying informed, long-term perspective, stop loss orders, and working with a professional. So, diversification, what is that? Well, that is spreading our investments over several asset classes and sectors and geographic locations. So, how does that help you? Well, let's just say that there's a lot of instability occurring in the IT sector. And so that's causing prices to drop. in the IT sector. Well, if that only encompasses a small portion of your overall portfolio, you're not going to be impacted that much. So volatility is not going to be a big issue for you. What's the second thing? Asset allocation. And what that is just having a proper balance amongst asset allocations for you. And by that, I mean creating a portfolio and how it's invested tailored to your specific goals and your time horizon and your risk tolerance. So if you've done a good job of doing that, then you're going to feel a lot more comfortable when we have all these temporary shifts in the markets and all this volatility, because you know, well, yeah, if I stick to my strategy, I'm going to be okay. The third thing is use of derivatives, and this is just a financial tool that's available to us, and that's where we get into option contracts. Kind of a complicated thing. I wouldn't recommend you do it on your own. You probably need help in that, or I'd recommend you get counseling in that. But what it is it's a way to position these futures contracts so that way it protects us during the downside or the downward pricing pressures. And then actually, if you place these contracts correctly, you can actually make money in high times of volatility. So you can make money while the markets are going up and going down. But once again, like I said, I would really work with a professional if you're contemplating using that instrument. Staying informed, I think, is one of the biggest things that we can do as investors on our own, and that is just staying abreast of what's going on. Are interest rates going up? Did the government drop them, raise them? What's the unemployment rate? Where do they see it going? Things like that. If we are better informed, then that helps us prepare and create a much better reaction to volatility. Long-term perspective, this is key. So if you've created the perfect portfolio for you based on what you want to achieve, then stick with it. In doing so, then you don't necessarily get impacted by all the short-term gyrations and all the minutia that's happening. You just kind of stick to your guns, and you're going to have greater probability of investment success. But here's another instrument that's available to us, and that's stop loss orders. Well, what is that? Well, that's where we set a predetermined price on a particular investment, and if the pricing drops to that level or below, we automatically sell it. So therefore, it prevents us from taking more losses. But the biggest one, in my opinion, is working with a qualified financial advisor. By doing so, that advisor is going to do most of the heavy lifting for you. They're going to alleviate a lot of the pressures and the stress that comes with that. And they're just going to increase your overall probability and chances of success for long-term investment results. And so I really recommend working with the financial advisor instead of any of those other ones. If you just do that, that's going to help you. So anyway, I hope my video helped. I hope it gave you some information that you can use. As always, if you have any questions or want to discuss this further, I'd love to hear from you. So reach out. And until then, please subscribe to my channel, click on the notifications, and like this video. Have an awesome afternoon.